What is the State of California Dream for All Shared Appreciation Loan? CALHFA, which is a California Housing Finance Agency, will lend you up to $150,000 at 0% interest. The best part is that loan can be used for your down payment and closing costs with little out of pocket. In exchange, CALHFA will keep 20% of the future home appreciation. Watch this video until the end and I will go over how it works and some examples. So first, let's talk about the requirements. All borrowers must be a first-time homebuyer. The definition of a first-time homebuyer is you have not owned a home in the previous 3 years. At least one borrower must be a first-generation home buyer. That means that you have not owned a home in the United States in the past 7 years, and your parents currently do not own a home or have any interest in a home in the United States. Now, the minimum credit score is going to depend on your income. Most borrowers are going to need a minimum of a 680 credit score. However, it does go as low as a 660 credit score if you're below 80% of the area median income. Now, for the property type, you're able to purchase a single-family, one-unit home, a condominium or townhome, or a manufactured home as long as you're purchasing the land and it's on permanent foundation. Now, there are income limits, and that's going to depend on the county that you're purchasing in. So here's some examples. In Riverside and San Bernardino County, you cannot make more than $149,000. No more than $202,000 for Orange County, $185,000 for San Diego, and no more than $155,000 in Los Angeles County. Now let's go over some examples. This first example we're going to go over is a purchase price of $500,000. We need around $80,000 to $100,000 of yearly income. Now this is going to depend on your credit score and your debt. So for a $500,000 purchase price, you get 20% for the Dream for All program funds. That equals $100,000. Now this loan is at 0% and there's no monthly payment. So that makes your first loan amount at $400,000. Now let's say in 5 years, the home value goes up to $700,000. That means that you would have a new loan balance of about $375,000 because we've been paying down the principal of that loan every month. So you have $325,000 of equity in the home. Here's how much you would have to pay back for that Dream for All program. The value again was $700,000. You originally purchased the house for $500,000, so you have $200,000 in home appreciation. CALHFA will take 20% for the Dream for All shared appreciation, which is $40,000. You pay back your original $100,000 for the down payment and the closing costs, so you pay back a total of $140,000 to CALHFA. Now here's the best part. This is how much you would keep. Again, you have $325,000, which was the equity in the home. You paid back the $140,000 to CALHFA, and you would have still left over $185,000 in equity in only 5 years. Here's another benefit. The monthly payment is also low with this program. For a $500,000 purchase price, your estimated payment would be about $3,200 a month compared to $4,150 a month if you were to do a traditional loan, putting 5% as a down payment. So you're actually saving $950 a month, which comes out to $57,000 in 5 years. Now, a lot of people say, well, they're going to get 20% equity, which is that $40,000, right? But again, you're saving $57,000 in monthly payments in that 5 years, which makes it worth it. Now, let's talk about another example, which is a higher purchase price. So let's say we buy a house at $800,000. We're going to need between $130,000 and $150,000 a year of income, depending on your credit and the debts that you have. So in this example, we're buying a house at $800,000. We get the maximum $150,000 for the Dream for All program funds, and that makes our initial first loan amount at $650,000. And again, let's say in 5 years, the home appreciates to $1 million. We now owe $609,000 on the balance of the loan because we've been paying down the principal. So we have $391,000 in equity in the house. Here's how much we're paying back. You have the $1 million value in those 5 years. You originally purchased the house for $800,000. So you have $200,000 home appreciation. CALHFA will take 20% for the Dream for All appreciation share, which is the $40,000. You're paying back that original $150,000 for the down payment and your closing costs, and that's a total of $190,000 you're paying back to CalHFA. However, this is how much you're keeping. Again, you have the $391,000 of the equity of the house. You paid back the $190,000 to CalHFA. You still have over $200,000 of equity in just 5 years. Now, the monthly payment, again, is very low. For an $800,000 purchase price, it's about $5,275 versus paying $6,600 a month for a traditional loan. So that saves you $1,325 a month on the payment. So again, we are paying that 20%, which is the $40,000 appreciation share, but you're saving $79,500 in monthly payments in just 5 years. So when is the Dream for All shared appreciation loan actually due? It's when you sell the home, when you transfer the title of the home, when you pay off the loan, or when you refinance. However, CalHFA is allowing a one-time refinance through the life of the loan, so when interest rates come down, we can refinance and get you an even lower monthly payment. What do we need to apply? The first step is to contact me, your CalHFA expert. I will go over your income and we will see what the maximum is that you could get approved for without having to run your credit. The funds for this program are very limited. You will be entered into a voucher lottery, so not everyone will be able to get this program. You also have to act fast because we have until April 29th to submit your application. At that point, they'll randomly choose, and if you're selected, you will have 90 days to be able to find a home. If you have any questions, contact me, your mortgage pilot, safely flying you through the home loan process.